Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the 10-year yield and mortgage rates after China tariffs and a whole lot of other things going on. Before we dive in, I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
Yes, I'm in lovely Alabama today. Such a lovely resort that I'm staying in where I'm going to speak in a few hours. But it was funny because today, the 10-year yield is fighting with that 4% line again. This is the third time. But the fact that we're having this conversation in the middle part of October warrants a bigger discussion, like what just happened this year for us to even talking about the third time we're testing the 4% 10-year. And for us, it's very simple. For those who have followed the podcast or seen me speak live, the slow dance since 1971 has nothing to do with mortgage-backed securities or anything like that. 65 to 75% of where the 10-year yield and mortgage rates can go is Fed policy. Then the rest is pretty much, either economic growth, nominal growth, wages, inflation expectations. But then there's all this other stuff about federal debt and all that stuff that doesn't really matter to what history has shown us. And this is why, Sarah Wheeler, we can talk about, does the 10-year yield break 4%, which it hasn't been able to do all year? And could mortgage rates even go lower?
I love this discussion. First of all, we would love to see mortgage rates go lower, but also the fact that you've been tracking this and looking at what are the factors that are going to do this, and that 10-year going below 4% is key. So I asked you this weekend because I was like, with the tariff announcement late on Friday, it was not clear what was going to happen there. So maybe recap that, and it turned out to be not anything big.
So Trump and China are back and forth trolling each other. And China believes that if the stock market goes down, he will fold on tariffs on them. So this is the market participants are talking about this. This is where that taco, name came from. But we've had other trade people that work with the White House, Greer and even Bassett, talk about, the markets and the stock market and bond market. They're keeping an eye on everything. I think it's a little bit different now because there's a government shutdown. The tariff collections are picking up. So there's going to be some goods priced spillover. And I think at this point, if the markets went down with that, China's hoping that, they can get a better deal from Trump. So everyone's just rattling each other with, now the latest is we're not going to buy their cooking oil,
Right.
And I think the market lost I don't know, $1 or $2 trillion, whatever, in 10 seconds or so, some crazy thing like that because of the cooking oil headlines. Like, who knew cooking oil was so powerful, right? So we're in one of those things. But you take all that noise aside, why are we even here? Why are we even at 4%? Because we're broke as a country, 37 trillion in debt. That's the line every single year since I can remember. 1 trillion, 2 trillion, 5 trillion, 10, 15, 20, we're broke. Number two, we had so much treasury supply coming out. We had so much a bond auction that there's no way the bond market can handle it. Absolutely no way. We are a broke country. That didn't work either. By the way, that one was the hilarious one because the Republicans were so afraid of this actually being something real where they didn't need to be, that they were telling their influencers to tell everybody, hey, listen, if a recession happens, it's fine because we have to refinance the debt. It's like, you guys are very predictable because you all say the same thing, and you can see it's a summer camp thing, right? And you didn't need a recession to get the debt. We're good on that. So it goes back to how we forecast mortgage rates and the 10-year yield is that we work off waves and channels, and we try to figure out where Fed policy is and where it is in the economy. And the 10-year yield peak was 470. If we're up there, the economy is doing really good. Right? Labor market's fine, but if we're getting close to the 380, that means the labor market's getting softer. And that's been the last few years. So if you believe in this principle that 65 to 75% of where mortgage rates in the 10-year yield range is still Fed policy, the Fed is cut now 1.25%. They're guiding to maybe 2 more rate cuts. it's really hard to get like, the 10-year yield above 5% or something like that in this kind of environment with the labor market getting softer.
Okay, so Jerome Powell, Fed Chair Jerome Powell, seemed to to read the tea leaves better, or at least come around to your point of view this week. What did he say about labor?
One of the most shocking things I heard Powell ever say is that the theory that you could have zero job growth and that would be a break even. I don't know if that was like an old man, brain going bonkers, but to go out on TV and say zero job growth is part of the break evens, that is like historical. That to me is like him telling the bond traders, I don't care if there's one job growth, you don't go below the line. So he kind of took that back a little bit and said that maybe 50K, right? Because break evens are kind of like you're just trying to model something out between labor force growth. So nobody knows the exact number, but I'm glad that he took away that zero number and talked about 50,000 being it, because that's a little bit more respectable, and that these softer data lines, the bond market is going with that. And at some point, even if you are the Fed chairman, if the labor data is, I think what Powell did is a few meetings ago, he was so arrogant in his this labor market is solid and the unemployment rate is low, that it left him opening to any kind of bad reports. He loses credibility as an economic watcher. So it had to happen really fast. It's like, the Fed shot the labor market and then they're like, hey, why did it deteriorate so quickly? So we're talking from a span of maybe weeks where you had a Fed chairman say solid labor market. And then we have Beth Hammack, who just weeks ago kept on saying the labor market is robust. These are adults. I understand if it was an 8-year-old kid, but you cannot be a Fed president and be this wide in a very short time. So that's a positive thing that, he's saying the labor market's trajectory is deteriorating. Okay, that's an acceptable term. If he'd just used that a few months ago, we would have been, in a much better spot. So labor over inflation, we are at the low end of the 2025 forecast. It's going to take a lot more to bring this lower and to take mortgage rates lower, but we are here because of the two principles, right? The higher rates crowd were deficit spending, immigration is going to be inflationary, inflation is going to take off, a higher Fed, all the tax cuts are inflation, none of it worked. We're here at 4%. That looks normal, but that looks normal going back decades and decades and decades of where the 10-year yield and mortgage rates could rate. And then you add the third variable, the spreads, and the spreads are better this year. So if the spreads weren't as better, mortgage rates would be a little bit more elevated. But now hopefully this makes sense. But see, this was like one of those years to where you had everything in your book for higher rates, higher inflation, higher, debt, all that. None of it worked out. Labor market just ran over everyone.
Also, we've seen that you've been tracking, like, yes, you thought that the 10-year yield would drop to 4 and then come back up, but not like this huge bounce. So maybe walk us through that.
So a lot of people last year, they saw the Fed cut rates 50 basis points, but then they saw a mortgage rate shoot up. But as we've always said, Sarah Wheeler, nobody talks about mortgage rate went from 8% to 6% with no rate cuts. Even in late 2023, mortgage rates went from 8% down to 6.63%, and there was no rate cuts even being talked about at that point. So we've had these huge moves lower with no rate cuts, and nobody wants to talk about that. But all they want to talk about is, well, the Fed cut rates and mortgage rates went up. The 10-year yield was so low that it was pricing in a recession, and Fed policy was up here. So they have to convert. One either has to come down or the other has to come up. And back then, on the rate cut, we weren't having 20 or 10,000 jobs created. So, the economic data has brought it up, and the economy is still growing out here. But I think that's always going to be the confusing point, because people cherry pick this. Because I don't remember anyone talking about, except for us, that, hey, by the way, mortgage rates just fell 2%. There's no rate cuts, right? So the bond market gets ahead, right? And this year, because we have 1.25% rate cuts in the system, because the labor data is softer, we didn't see the aggressive move higher in bond yields, because the bond yields didn't even go down to 360. this year. So it's a much different backdrop. And now, after the rate cut happened, the 10-year yield is exactly where it was on the day of the Fed meeting, right? So that whole 2024 bond yields could go up, rates could go up, and then all of a sudden we're back here again. Fed policy, labor data, those two keys right there. And then we just move off of that. And if the economy picks up and the labor data picks up, you have potential to go up, because even the most dovish Fed presidents are coming out this week and saying, we're still modestly restrictive. They keep that modestly restrictive verbiage there because there's a time where they could go, we don't want to be modestly restrictive. That's a cue to bond traders. Go on, boys. Take them lower if you want. We're good.
Okay, so speaking of data and jobs data, how do we know what's happening if we don't have any of that government jobs data? What are you looking at right now to see what's happening in the labor market?
So there's one way that a lot of people track. They track the tax data to see, how much tax receipts we get. And that's kind of an old market, tracker that a lot of people do. And so far, that's holding up pretty well, considering. There are surveys out there. The small business survey came in. Some of their things weren't that great. So you keep an eye on those kind of data lines. Now, of course, existing home sales is not the government. New home sales, housing starts, and those things are census. But the builder survey is going to come out by the time I think when this podcast is out there. So there are data lines and things that we track. Even the Fed says we do have things that we can track out there. You'd rather have a full set of data lines. I mean, to me, if Trump is telling the BLS to come back and do the CPI report, get him back in here. Get the data, because of the situation we're in with monetary policy. Make that exception for the BLS and the census. So we can get data out here as fluid as possible. You want to shut down everything else, fine. But if you're going to do it for the CPI report, why not do it for everything out there?
I mean, just as a point, I don't think that the executive branch can bring people back to pay them because the Congress has to vote to pay them. This is the problem, right? So, but to your point, if you're going to break the rules for CPI data, break the rules for the jobs data.
Yeah. So, I mean, if you're going to do it. But it's one of these things with shutdowns, right? You're just playing, a chess game between Republicans and Democrats. But in this contest, there are things that we can track that will be okay. But you really want the full set of data lines. But I think partly is, the China news and the U.S. at this point, that needs some clarity out there. But China thinks, because of what happened with magnets and all that stuff, they think they can get a better deal out here. And again, we're going to punt probably a lot of things going out in the future. But it is an interesting. It's been a very interesting year, because I think this year, out of all the other ones, because of tariffs, because of this treasury supply, because of 37, so many people weighted things that historically might not have been the case in a Fed rate cut cycle where we've cut rates. If the Federal Reserve said we want to raise rates, right, that's a whole different thing. But they've always maintained that raising rates in a trade war can be recessionary. So in that context, it's out there. And of course, the dollar is down. So, in a sense, the Trinity game plan we've always talked about since November of 2024, that Trump wants a lower dollar, lower energy prices, and lower yields. He's getting it, right? He's got all those three. And that makes whatever happens with tariffs and the surcharge or the tax, or however you want to call it, a little bit easier to handle out there.
And as we've said, in this way, in a trade war with China, China has the upper hand in some ways because they can just wait us out. I mean, they're not going to have midterms next year that they have to, make sure they're doing something popular or showing something. I mean, they can play the long game in a way that no U.S. president can really do that, because of just, the fact that they're going to have to face elections before that.
There's midterms. The thing is that China, in regards to our economy, isn't that big. But they are trying to export themselves out of a bad economic time. Their bond yields are much lower, right? Because their economy is much weaker. So it is a test on how much China wants to push the lever on that. Of course, it's really hard to do big major scale changes and limit the damage in America because you have 2-year political cycles. But it is an interesting point to where you can see that there's a rift between China and the U.S. right now, and there's gamesmanship being played. And clearly, Trump, when the stock market fell, he even asked Bissett, "What should I say to get this to stop?" So again, we're playing chicken with trade wars, and we did this the first time around, but we're at that stage to where you probably need to get something done, and a government is shut down on top of that. So there's a lot of things going on at this very moment that it's a little bit different than the last few months.
I feel like given all that is going on, things are pretty stable when it comes to mortgage rates.
Well, it is, and it's part of that is, I think, not having the data out there is one. And when you don't have the data and you have a government shutdown and you have this tiff between China, bond traders are going to be probably a little bit more pessimistic than optimistic. If they were more optimistic on the economic data, then you could push yields higher. But again, we already have 1.25 rate cuts in the system. It's not like last year where we started the rate cut cycle. We are forward guiding 2 rate cuts into the system. But for everyone listening, I think this is very key. We are almost pricing in neutral policy. Like people think that rates are going to go down to like the low 5s or something like that. Neutral policy gets you 5.75% rates out there. So a lot is already priced in. So there's a lot of rate cuts already priced into the bond market already. So even if you had better spreads, it's really hard to kind of get to the low 5s with neutral policy because the Fed is modestly restrictive. They need to change that language to get rates to go. This is why I don't forecast below 5.75%. It's because, to me, neutral policy, that's what it is. That's the best you can get. So when people see, well, we get rate cuts, so much of the rate cuts are already priced in today, with a 4% 10-year yield. So it's just, it's a confusing topic, but I thought, if we do it on a slow dance and kind of the back and forth with economic data and Fed policy, it tries to make a little bit more sense. But we're here, we're testing the 4% level again. This is the third time, and it's happening in October.
I think most people in our industry, 5.75, they would be thrilled with 5.75.
They would be, but I could still see like some people say, X is going to happen and rates are going to get below 5%. I said, you really do need, not modestly restrictive or not neutral. You need an accommodative stance out there. And it's just a really good example. 3.25% on the 10-year yield with normal spreads got you 5% mortgage rates. But that was with zero interest rate policy, or the Fed funds rate, at kind of 1.25 or 2%. So you need things to kind of go lower with the Fed to get that, bandwidth lower.
Okay, last item, purchase applications. What do we see?
Purchase application data came out, 3% decline week to week, 20% increase year over year, but we always want to focus on the week-to-week data. Last year at this time, mortgage rates were heading higher. So the year-over-year comps are much easier to show that year-over-year growth. But if you look at the week-to-week data, we've been slowly moving lower. Nothing big, nothing like we had in the past where when rates go up, we have this noticeable dive, but slowly moving lower. So the last 11 weeks, we do the count, 7 positive weeks, 4 negative, 11 straight weeks of double-digit year-over-year growth. Again, that's still the best purchase application data we've had on the year, and rates are down at this level. So still a positive trend, but to me, the weekly data are slowing down, and I really need to see 12 to 14 weeks of positive weekly data within a time period to make it something material. But the year-over-year data is confusing everyone because I think that's 36 straight weeks of year-over-year growth. That's, I think, 25 straight weeks of double-digit year-over-year growth. This is 11 straight weeks right here.
That's crazy. But like you said, you have to take that in context. This time last year was really, really bad.
It is. And last year we didn't have any kind of year-over-year growth in the data until like October, but we had a lot of week to week growth, and then we had a couple 100,000 home sales. So I think the purchase application data can be very confusing. Last year and this year is a really good example, but the forward looking data that we track are a little bit positive on a year over year basis.
Logan, thank you so much for being on. And as always, listeners, you can find everything that he's talking about from the tracker, at least, at housingwire.com/housing market tracker. It's an amazing weekly compilation of all this data that does not rely on the government. So we have our own data, we have other data sources. So check that out. And Logan, thanks so much.
You don't fly blind here. The Chart Daddy's here 24/7.
Lots of charts in that tracker, let me just tell you.